Matt, good to see you, man. Good catching up beforehand, and I'm excited to dive in on some fun stuff today.
Yeah, I noticed one of the things that I think you and I share a similar, sentiment. Obviously, we love commercial real estate. We love finding ways to leverage, the vehicle of commercial real estate for a variety of different benefits. You mentioned something that you said you guys invest kind of based on two belief systems. Wall Street is broken, real estate is the cure, and economics tell the future. I know we're going to talk a little bit about both of those today. What led you to those kind of two tenets of your investment, thesis and ideology?
So I love the question, and yeah, those are core beliefs that we have. The fundamentals of the stock market, I think, are the most alarming that we've seen, at least in my generation. I think a lot further if you dig in historically. If you wanted me to oversimplify just a few points to put a firm dot on that, what I'd say is this. The stock market, as you look at it today, since 1995, the number of companies has reduced by over 40%. Okay. So less companies want to go public. And the effect of that is that us as investors, listeners, all of us here that are interested in finance and building a better future through investment, we don't have access to the same diversification that we used to, simply put. And I would argue, if you dig into the numbers more, that even many of the best companies are choosing not to go public. So it's not like the best and the brightest companies are still going into the stock market. I don't think that's the case. Private equity, meaning private investment, has increased during that same time since 1995 over 6x. So I think the fundamental idea that the stock market is a vehicle where the best companies have access to the most people and we as investors have that diversification, I think that's out the window. So that's one. I think the solution to that, because everything, economics, et cetera, I think we need to always talk about, so what? What does that mean? What do we do about that?
Yeah.
I think that means that private investing, whether that's alternatives, whether that's going to private markets, those private investors have better opportunities than they've ever had today. That's the good news of that. The second is, I think economics tells the future in the way. You can say that demographics is destiny. You can say that economics tells the future in the sense that we know where many longer term trends lead, right? We can see the baby boomers. We can see Gen X, millennials, Gen Z. We know how those sizes of generations will impact things in the future. We also know in economics, things like the fact that we have 36 trillion in debt in the United States. We know things like many countries are selling off their US bonds. We know things like the debt is expected to increase. We know that that we haven't had a balanced budget since 2001 in the United States. These are things with long-term effects that have long-term impacts. So I encourage investors to always stay close to this information and always ask, so what does that mean for me? What does that mean for my portfolio? What does that mean for my future? And that's what we've been obsessed with at Saint. Those two things, finding alternatives, finding the best investment alternatives to the stock market. And then the other is staying close to the economics so we can see trends 1 year, 5 years, 10 years out and be on the right side of history on those.
Yeah, data is at least our closest thing to a crystal ball to give us some guardrails at least. And I would even argue that data of the past is not necessarily equal to the data that we're seeing today. Would you agree with that?
I agree. I think there's fundamental shifts where
Yeah.
you look at numbers of the past and they just don't apply in the same way. We see in the stock market PE ratios near record highs, depending on what sector. We see things overweighted. We see in real estate, we've seen a return shift. We've seen strategy shift. So looking at data of the past, I think it's helpful, but it's also not today's environment. So it's understanding both. I agree with you on that.
Yeah. It's not necessarily indicative of the future, especially with new, layers of AI and tech and, just like you said, economic and global shifts, the policies, that are at play today versus, previous data sets. When you talk about this concern over, Wall Street, the stock market, sounds kind of dire, little scary. Like, how do people think about and navigate Is this going to be just a total, meltdown that comes crashing down and we're going to be the generation that, is the one to experience it? Or is there a silver lining and opportunity in all of this?
I think there's always opportunity. So I try to balance both. I have some dire thoughts on many stages of the market, but
Okay.
I also
I
think
want to
that
hear some of those, by the way.
Oh, I'm happy to. I'll dive all the way in, but I'm always optimistic also. And in the US, we have a competitive advantage, an unfair, to be clear, an unfair competitive advantage. And I'm so bullish on the US long term. So I want to always make sure that, that's at the very front of everything. But yeah, I mean, I think that we have a currency crisis that we need to resolve. I think that we're in a political environment where neither side really wants to affect the deficit in a positive way. And then you see that trickle into investing. So if you look at the stock market, we just hit another high for the S&P 500, right?
Yeah.
We should be celebrating that. But if you look at the alternative, there's this weird question of, did companies become more valuable? Did they earn those higher valuations? Or did the Forex market show that the US dollar was around 11% less? So there's more dollars required to buy the same amount of stock, right? So now we get into questions of, is a worse dollar better or is a worse dollar worse? Because at the end of the day, it takes more dollars to buy the same amount of shares of a stock for the same amount of income, if you want to think in price to earnings ratio. And that starts to be a little more complicated than everybody high-fiving over an S&P 500, right?
Yeah.
So, yeah, I think that the stock market's overweighted. If you look at the Magnificent Seven, it represents, I'd have to check today's number. I think it's like 30, at least a third of the market. I thought it was even higher than that.
Yeah, it was
market values.
Yep. 33% is what I saw last.
I mean, Matt, that's massively overweighted, right? You look at other countries, our stock market's done what it's done this year. It hasn't been too bad. It's really not bad at all historically. But you look at international stocks that are doing great, right? And so my dire thoughts would be, I think the US dollars are number one concern right now. I think that the concerns behind that are fueled by overspending. Simply put, to oversimplify it.
Yeah,
I
100%.
think that as our debt builds, we create a spiral of, we have too much debt, we print more money, then we have to go into a debt situation where we have to issue more bonds, and then on the back end, that creates more debt. And the net of that cycle is inflation. So investors being on the right side or the wrong side of inflation, I think is a question of where they're putting their money. We know the dollar's not a good place for money right now. We know that 80% plus of every dollar's been printed since 2020. So if you have one pizza, right, if you want to oversimplify this, if you cut it up, the more you cut it up, the smaller the slices. That doesn't add more pizza. We're blessed in the US that we have the greatest GDP in the world. We're blessed that we're, energy independent. We're blessed that have an amazing military that supports us and protects many of our freedoms and ideas throughout the world. But at the end of the day, the dollar situation, I think, is unresolved in the biggest way. And I think that is the biggest opportunity we have to resolve to, create a good future for the country.
So if dollars are one of the riskier places to, keep your capital or your wealth, where, in your opinion, do you think is the greatest hedge against some of these risks? How do you mitigate that, right? And where do you think, some of the best opportunities are in comparison to what you're seeing with some of these risks with the US dollar?
So you talked about what my hot takes are. Let's talk some hot takes. You want to talk some hot takes now? Okay. I historically invested in the stock market. I historically invested in bonds. Like I said previously, I think the private markets are really the future. So,
and define for somebody that doesn't understand what you're meaning when you say a private market. Talk about that real fast.
Great question. So privately owned investment opportunities. So let's talk real estate. Let's talk, things in that world, alternatives to the stock market. Historically, we had traditional investments and alternative investments. Traditional investments were stocks and bonds, is most classically defined as, and then alternatives are real estate, commodities, Bitcoin, things in that nature.
Yep.
I think the private markets, the alternative markets are the future. So I think the opportunities historically we had in the stock market, I think are going to be replaced by largely, I think real estate is the biggest opportunity over the next 10 to 20 years. And then instead of bonds, I think that's going to be replaced by fixed income strategies. So whether that's real estate backed, whether there's some other strategies in there, I think those particularly are the future of alternatives, or excuse me, are the future of things like stocks. I think you're looking at alternatives that have appreciation opportunities like real estate, tax benefits, also cash flow.
Yeah.
So it kind of hits all layers there. And then I think the fixed income opportunities that bonds used to have, there's many safe alternatives that are less problematic than bonds. So what I would tell investors that I believe the biggest opportunities are is for their appreciation side, for their growth side of their portfolio. I think real estate is the biggest opportunity. For fixed income, I would be looking at opportunities that are backed by cash flowing assets. Again, I'd probably choose real estate. I'm very biased. But the reason, the core of it, especially on the real estate side, is that you're dealing with an asset that gets you out of cash. It's based on a real investment. And frankly, it has competitive advantages beyond what stocks can offer. You have the tax. For me, there's three things that I'm looking for in any investment. Does it cash flow? Does it have an appreciation ability? And does it have a unique advantage? Real estate cash flows, maybe not as high if you're leaning into the appreciation side or a longer term strategy there,
Yep.
but it also has appreciation opportunities, amazing hedge against inflation from that perspective. And then the third, you have the tax benefit. You have that unique advantage that I don't think that many other investments today have. So that's where I say shifting the focus to the private investments. I think most of the best investments are staying private. We know statistically they're not going public. And that, so if you're focusing on the private markets, you're dealing with the best, the brightest, the biggest opportunities by a statistical percentage in today's breakdown.
Well, I've never been somebody that was, considering myself the fastest, smartest, or strongest. So I always try and track those that are. And when you see a lot of the big private equity, big REITs, big hedge funds, and watch where their dollars are going, because they're way more capitalized, they're way more resourced, they're, way more capable of identifying the next trend. I remember when I first got into real estate back in 2010, and I broke into wholesaling houses. And this was back, when foreclosures were everywhere here in California. And I was locking up contracts and I was selling them to Blackstone. I was selling them to US Homes and these big funds. And I'm like, man, these guys are freaking way overpaying for these properties. Like, this is insane. Like, these guys are idiots. What do they know that I don't know? Well, fast forward a decade later, I mean, they were theoretically buying these houses for 30, 40, 50 cents on the dollar based on where the values are at today, right? And so when I always think about paying attention to what the big boys and girls are doing, because smart money always knows where the next opportunity, where the next trend is. And so if you can somewhat ride their data, ride their coattails and actions, oftentimes they're going to lead you into, some spaces where there's opportunity. And right now we're seeing a lot of these groups make big bets, ding, 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 in private investments, like you're talking about, right? And so, with Trump trying to protect the, US dollar in some capacity on a global stage, I think yesterday he talked about, putting a 10% additional tariff on anybody that was collaborating or communicating with any of the BRICS countries. There's always kind of that little narrative, hanging out there around BRICS and, will the US dollar remain the, currency reserve of the world? You got Scott Bessent saying that's not going anywhere. I've even heard, some of the Jamie Dimons and other people, kind of waver on that, but still kind of say, yep, it's not going anywhere. But it does seem like now more than ever, there feels like a real tangible, maybe not short term, but longer term threat. And therefore people are reallocating, repositioning accordingly. And you guys have done that as well. So I'm just curious, with the data that you are using, what has kind of led you to shifting and reallocating your business, your focus, and the resources that are servicing your investors to capitalize on what you guys believe is the next opportunity or space to not only protect and mitigate risk tied to the capital and returns that you guys are looking for, but obviously to capture those?
Great question, and a lot of good details there. So can I hit on a couple of those points? Because
Please.
I think there's a lot of great insights there. Let's look at the big boys, exactly like you said, Matt. I'll just take BlackRock just because they're such an obvious behemoth of an example.
Yep.
Look at, I was just reading, I was just listening to an interview with Larry Fink. If you break down BlackRock's investment strategy over time, right? Because the change is what's important. What their new strategy is and what they used to do shows the prediction of where they think the market's going. Their holdings in alternative assets, in hard assets, in real estate assets are up like 3x. That's their game plan today.
That's telling.
Right? So you look at a previous 60-40 portfolio for us as Americans in previous generations, we're not even tapping into that. Right? Previous Americans, 5, maybe 10% of portfolio was going towards real estate and alternative assets.
Yep.
Today, you look at BlackRock, they're around 40%. So if I'm looking at their dollars, I want to match them. I want to go their direction, right? Exactly what you said. The second is, you look at sentiment of Americans, later generations. Baby boomers, a little more conservative, a little more traditional, but also represent 82 trillion in wealth that's going to be passed on in the next 15 years. The generations that will recover that wealth, Gen X, especially millennials, right? Mostly the children of baby boomers, and then Gen Z. If you look at the trends of their trust, our trust, I'm a millennial, our trust in the real estate markets, it's about 3x what previous generations were. That's on trend much more closely with what BlackRock thinks as well.
Yeah.
So that's the trend that I see. That's the trend in the future. I think real estate has a huge opportunity because of that. But the future of the US dollar, like you said, hey, BRICS pay, they've talked about BRICS pay. What do we look at it like? Is the US dollar going to fall from the sky? Are we going to completely walk away from it? Is the world going to move on? I think the biggest question that I have is not, are we managing our currency perfectly? I think we all know that's not the case, right? But the bigger question is, it's like boxing or UFC or whoever. It's like, well, who's going to dethrone that person?
Exactly.
Who's going to dethrone the champ? And the reality is, it's a short list of even discussable possibilities. You got the euro, right? No, right? We're talking less than 3% of global trades on euro. The euro has plenty of problems on their own: demographic collapse, economic issues on the horizon, major issues. Really, they look to the U.S. for a lot of leadership and support and economic and military, et cetera. So we know it's probably not the euro. Then we can get into, well, what about China, right? Big economy. We're diametrically opposed to China in many ways right now. We're negotiating, big trade discussions. They're withholding precious metals, precious earths, rare earths from us, right? We're in this kind of locking of horns. The reality is the CCP, the ruling body of China, at its core, does not want a currency they can't control. Part of the amazing thing of the US dollar is there's so much in circulation, and it's still managed today at about 2.3% inflation. That is an absolute achievement on its own. So it's unlikely to be China. So then we get into alternative currencies. Is it going to be BRICS pay, right? Brazil, Russia, India, China, South Africa. They've expanded that. That now has, I believe that has Iran and Saudi Arabia in it. Just no, right? Because just the fact is, I think it was in the last 18 months at the BRICS summits, I think it was India, China, and South Africa all were extremely clear and came out, including China, saying we have no interest in replacing the US dollar as the global currency. So all that to be said, one, I don't think BRICS could ever get together and agree on anything. Good luck getting Iran and Saudi Arabia to agree on a currency and how that should be managed. But even the other countries, Russia, India, China, no. So where we're at is we're the best of the worst, I believe, on the currency side. I think we're mismanaging it. I think we still have huge opportunities to get this train back on the tracks. But I think there's a huge upside for positive investment decisions in the future, mixed with the fact that we have such a robust economy, such a robust system of government and things that can. The one nice thing about democracy, it can bend a lot before it breaks, unlike something like a dictatorship. So
Yeah.
I still see us as the shining star. I still see the US dollar as, decades ahead of being the reserve currency. But that does, every time that we mismanage our dollar, we have negative ROI investment into our economy. We have negative ROI decisions that we make against our own currency that degrades the currency, that degrades trust. Over time, that will be a big problem. I just don't think it's today.
So let's shift over to the One Big Beautiful Bill Act and talking about more spending, talking about a mismanaged, budget and deficit continuing to increase. We've seen some positive stuff with tariffs, but obviously that's not going to get us out of this problem. We have recalibrated some of the trade deals. We've gotten a lot of foreign investment. I forget where it's at, but trillions of dollars at this stage with Trump, bringing in more every single day. Do you think that we are headed into the golden era in America? And if so, how are you guys positioning yourselves to get your unfair share of that slice of the pie?
Oh, I like that. Unfair share. That's a competitive advantage. I love it. So
Yes.
This is my take on the current state of affairs in the wake of the big, beautiful bill. The biggest hangup, and again, I'm a political independent. I lean to the right because I'm an economic voter. And right now I side more with the right economically, typically, than I do with the left economically. I believe that when Americans have more money in their pockets, their wages are growing well, above inflation. We have a robust middle class. I think that's good for the country to the very core. Okay.
Yep.
My biggest issues with the big, beautiful bill, I'll start there. It's just the freaking deficit it creates. Simply put, I don't think they tightened up the numbers to a degree that put us in a position where we're going the right direction. I think that actually expands. By 2034, our current deficit right now is $2 trillion a year. That spans 3 presidencies. So that's not a right or left issue. That's a united overspending issue on both sides of the aisle. The problem is that should swell to about 3 or north of 3 trillion by the mid 2030s. So we're going very much the wrong direction, right? We're at 36 trillion a year, or excuse me, we're at 36 trillion in total debt today. We're talking about adding over 10% to that per year in the next decade. I'm very, very, very much opposed to that at its very core. What I like about the big, beautiful bill is that it incentivizes things that the government wants money to go towards. I think opportunity zones are a huge strategy. We have multiple properties in opportunity zones. We've taken advantage of that. I think that's a huge opportunity for the private sector to revitalize problematic areas. I think that's great. If you look at the core of the tax code, people go tax loopholes. Oh, it's handouts for the rich. Well, the tax incentives are for the rich, the people that have excess money or have a high net worth, to put money into things that the government wants them to. I think conceptually that's good. I like the opportunity zone side. I also like the bonus depreciation side. Obviously, it benefits real estate dramatically. Let's get that out of the way.
Yep.
But also, real estate is the backbone of the country. We got banking, we have the currency side, and then we have the hard asset side, the real estate side. So I like the bonus depreciation. I like many of the benefits that go around the real estate piece. I think they're strategic for the company, for the country. In light of the fact that we are talking about tariffs, we're talking about Trump trying to raise the standards of who brings what into the country with the idea that he stated and Biden stated of boosting and bolstering manufacturing in the U.S.
Yep.
The whole strategy behind that, I'm aligned with. My background's industrial. I've always believed that there's a huge opportunity to bring manufacturing back to the U.S. We're the AI leader of the world. We're the robotics leader of the world. So maybe it's not just one individual, turning one screw all day and having an assembly line. It will likely include AI. It will likely include robotics. But bringing manufacturing back to the U.S., I believe, is the most robust way to boost the economy for decades to come. And that sounds like a tall order, right? Well, that sounds massive. Hey, billions and billions and billions of investment that's going to take a decade, blah, blah, blah. If you look at post-World War II, during World War II, let me rephrase that. During World War II, we had to ramp up in the U.S. We were in wartime, right? In 18 months, we built out our entire manufacturing sector that lasted for many decades.
Yeah.
That was the backbone of the US. That created a robust, strong middle class with access to jobs that boosted the economy, that immediately impacted GDP. So I don't think it's a decade out at the end of the day. And so I do think many great things about the bill are incentivizing dollars where the government wants them to go. I think manufacturing is a focus of the Trump administration. It was also a focus of the Biden administration with things like the CHIPS Act. Both sides of the aisle have talked about this. And if we can achieve that goal and support that goal, I think we wake up really with a robust middle class, with the opportunity to have a very, very entrenched and strong GDP. And I think that gives us decades of opportunities ahead.
Great breakdown. I know with, like you said, manufacturing being a big one. We know that Trump is very bullish on crypto and wanting America to be the, crypto hub of the world. Obviously, AI is a big driver of our economy and is going to continue, for many decades to come on that front. And, data centers, energy being a big critical component of being able to service the AI and crypto needs going forward with the proper infrastructure. And obviously, all of this is tied to what? Dirt, real estate. So talking about your guys' business model in the real estate space from an investment perspective, break down a little bit more about what Saint Investment is, what makes you guys unique and different, and how you have kind of found your niche within this expansive landscape that, you could, navigate through.
Sure. My background is pretty similar to yours. What your story was about, a huge overlap with mine. I got involved in the wake of the 2008 financial crisis. We were buying distressed assets, so opportunistic by today's terms. We were buying mostly at foreclosure sales or directly from banks. So we built reputations over that period of time of buying highly discounted, highly, high opportunity projects, that had big issues, whether it was required huge renovations, had some financial issues along the way, et cetera. We stepped in and bought those at a discount. So where we're at, if you fast forward today, is we've leaned into fixed income. Why? Because our investors in the wake of 2020 really wanted something that was more stable. They said, look, Nic, we've had great returns. Our average IRR is around 35.5%. So we're very proud of our syndication projects. Those numbers don't really exist consistently in today's market.
Yeah.
So our investors, many older, many shifting to retirement or in retirement, wanted something that paid fixed returns. So on our side, we were tasked with shifting focus to find assets in real estate. Again, that's our core. We focus only on real estate to find assets that would give 10, 20, 30 years of payments, consistency, and backed by an asset class that was rock solid and appeared to be rock solid by demographics and economics for an extended period of time. What we found as the number one opportunity for fixed income in real estate in today's market were single family mortgages. So our model today is we buy mortgages at a discount. There's usually some payment issues at some stage, whether they've missed payments or they have a rolling balance from COVID, or they're not making payments altogether. We buy those at a discount. We get those reperforming, and then those cash flow with 20, 30 years of payments ahead. Those payments are distributed to our investors, and we can reliably count on longer term cash flow on that side. The other half of what we're looking at opportunity-wise is the industrial sector. I'm extremely bullish on industrial for all the reasons that I said, manufacturing particularly, but also distribution, because those goods have to get around the country as well. So I think there's huge opportunities on those two. That's what we're focused on with the biggest upside for the next decade plus.
Beautiful. I recently was reading an article this morning. I think it was like CRE Daily had put out that, forget what group it was, and maybe it was Blackstone that was starting to allocate a fund arm towards smaller industrial, small bay, flex space. And to your point, right? I mean, obviously there's been these big bets on your credit grade tenants and these national brands that are doing big manufacturing, heavy industrial. But then there has been this kind of trickle down effect, right? Especially with somewhat of the democratization of distribution, of e-commerce, and this, need and desire for speed and velocity and proximity to your, and now all of a sudden an asset class that was that's too small for us on an institutional level is becoming the next frontier that they're looking at parking dollars. What are your thoughts on that?
I think it's smart. I think it's smart. I have a soft spot for their asset managers and their property managers, because the smaller the space and industrial, the more headaches. That's just kind of
sure.
the fact of how that asset class is managed. That said, small bay industrial or industrial parks, which are almost run like retail centers or storage facilities, et cetera, those have unique business opportunities. And if they're run well, you can push returns in a very interesting direction.
Yeah.
So more units, you can really push returns in great ways. We focus on kind of that mid-size, that like 40,000 to 100,000 square feet. We really have a niche there where our size of our properties are a little too small for institutional to be involved. And we're a little too big for the mom and pop 3 dentists that, combine cash and go in on a deal.
Yeah.
So we like that middle space. But the fact that big dollars or really big institutions are going in does not surprise me, because they can do it at scale. So they can build out asset management teams to cover a country, buy 100 projects, and really build a whole team around it. That doesn't surprise me. There are great opportunities on that side. And I think the industrial sector is still ripe for an amazing decade ahead.
Any other asset classes that maybe you guys aren't necessarily allocating dollars towards, but that you see having a, strong horizon ahead of them?
So I'll always say that I think multifamily is a good opportunity over the long term. Why? It's not because pricing, let's get that out of the way, because we know that I think it was 2022, where they're selling at 3.5 caps, right? You're spending 30 plus years, or you're paying upfront for 30 plus years of cash flow. That seems crazy. But multifamily is extremely blessed. They have great debt. They have government support. They have local support. They need that asset class in so many areas. So they get benefits that other asset classes don't get. What I would say is, so I think that multifamily actually has a positive horizon on that, although we don't focus on that or allocate to that today. I like retail. If you look at the story of retail in today's market, retail had this retail apocalypse, a decade ago, right? It was a real problem. I started my career in retail. My partners were very bullish on it, 15 plus years ago. I think there's a great opportunity. Then there's the retail apocalypse, especially, around the 2020 era, where nobody could leave their houses by government mandate, right? That was a scary time for the retail industry. We still have retail in our portfolio. We've been seeing it tick up dramatically. We've been seeing a huge interest increase. And if you look at the numbers, especially delinquency rates of loans, et cetera, with retail, it's doing better than many other asset classes, which nobody really saw on the horizon that wasn't looking very in depth. So I think retail starting to pick up in a big way and be a great opportunity as well. Again, we're not allocating there. We keep our strategy very simple. We're just focusing on the single family mortgages and the industrial sector. But I got my eye on retail, and I think there's positive things ahead for retail as well.
Well, as a retail investor, I love hearing that. And I agree with you. I would love to know more about how you are sharpening your skills. What places are you, tapping into for data? What are you reading? What ecosystems and, kind of networks are you plugged in to, keep at the forefront of doing what you do at such a high level?
Great question. And I think to be an astute investor in today's market, you have to, right? I think in the past, things moved much slower. And I think today they're moving so quickly that, like you said much earlier in our conversation, today's data moves so quickly, and it almost makes some of the previous data outdated. So here's what we're looking at today. We are looking at things like jobs consistently. We keep, a pulse on that. If you look at the Federal Reserve, they have that dual mandate of inflation and employment.
Yep.
So we're keeping a very close eye on that, because that likely will indicate not just the early signs of a recession, but also the early signs of rate changes. So we keep very close to job data. We're looking at that as jobless claims, projections on jobless claims, different industries and what those trends are, whether it's hospitality, government, et cetera. We're looking kind of across the board to see what what we would be seeing in the future. We're very close to inflation. We stay very close to the drivers of inflation, looking at PCE, CPI. Both are inflation measures. PCE is in favor today with the Federal Reserve, but we also look at PPI, producer price index.
Yep.
So it's a little bit of a precursor to CPI or PCE. It's what the producers, the manufacturers are incurring on their prices, what they're seeing, because oftentimes that's a leading indicator. So we're trying to find a lot of leading indicator opportunities on that. And then obviously we're drilling down deeply into local data. So on the industrial markets, we only operate in 2 markets. We love those markets. We think that they're, great, and the drivers of those are great. And we're looking very closely at that data, also with the broader manufacturing trends, how AI is impacting, how things like new asset classes or subclasses within industrial are evolving. Things like data centers, very interesting asset class. I like those unique opportunities. I think there will be a cap. I don't think we're going to have endless data center opportunities. I don't think that's going to be a forever opportunity. But I think that the opportunities that get in today, you'll see a great opportunity ahead for a long period of time for those that are entrenched. So it's staying ahead of the trends. We're looking at data. We have an entire economic tracker with our team that covers, I think, like 26 different data points for the economy. And then one of those is going to be the US dollar. What's the strength of the dollar? What is the impact of inflation? What's the Forex, the foreign exchange impact on the dollar right now? So when I say the dollar is down 11% in foreign exchange this year, I'm not proud of that statistic. I don't love that statistic. But then we look at things like government debt, because that right there is, I think, the rock in the hard place, because we want lower, or Trump specifically wants lower rates, because that will allow them to refinance the bonds that are coming due at the lower rates. The alternative is we don't lower our rates and we end up with a much higher debt service. We're already paying around $1 trillion a year on the US budget just to interest expense. That's painful, right? But if we can get that lower, that's a huge benefit. The flip side being, I think that has negative impacts on inflation. So I do think it's a rock and a hard place. So those are the data points we cover. Those are kind of the insights of why we look at some of those data points to make our decisions along the way.
Well, I was going to ask you, to your point, right? I mean, I've said the same thing, in light of the criticism, I still think Powell has done a pretty damn good job overall. It still doesn't make a whole lot of sense why they did a 50 basis point, cut right before the election. And now, they're continuing to at least hold rates where they're at. I know we had it starting the year, it was 3 to 5 rate cuts, baked in. Now I think we're still potentially 3. I know it looks like there's 2 for sure still baked into the market. What do you think Powell's going to do? What are your thoughts on how he's navigating this whole thing and just kind of the tension and the pressures between Trump and him and, what's going on that front?
I think you hit the nail on the head with what does Powell do? What's the future of rates, and kind of given the backdrop. I think I agree with you that I like a lot of Powell's decisions today. I'll say that. Historically, I think Powell has huge misses.
Yeah.
If you recall, it was, 2021, Powell and then Janet Yellen were screaming at the top of their lungs, inflation is transitory. Remember this?
I can't stand her.
I wanted to throw up, because anybody who's looking at even the most basic numbers knew that wasn't the case.
Yeah.
And transitory was such a BS word to be using at that time.
Yeah.
And within 18 months, we had inflation at 9.1%. Okay. So inflation, it turns out, was not transitory. It turns out years later that we're still above the 2% target of the Fed. We're at 2.3 today, right? So if we fast forward to today, though, I think Powell has taken his lumps. I think Powell has really learned from his mistakes of trying to be too far ahead, and that he's taking the data as it comes. I think that the wait and see approach is actually the right place to be absorbing the rate data, the data that surrounds rate decisions. And I think he's making the good calls. it is a rock and a hard place, because if we don't refinance, if we don't drop rates and refinance our debt, then we're in a bad position and our debt service goes up as a country. The flip side is, I actually think the inflation impact is going to be greater if we tank rates on that. My net thought, if you zoom out over a longer period of time, really, let's zoom out 100 years. The average rate in the US is between about 5 and 6% for retail mortgages, right? We're just a little higher than that. I think we stick there for an extended period of time if we're being diligent and balanced with the dual mandate of the Fed, which is to maintain employment and maintain low inflation around 2%. I actually think we should be sticking there for the extended period of time. If there's a recession, I think he should drop rates. If there's major issues, maybe with inflation, I think he raises rates. And I think those are good decisions. But I'm actually aligned, as much as I don't like many of the past decisions of Jerome Powell, and I think just the same as you on Janet Yellen, I think she's not the brightest bulb. I think that today's decisions are correct. And I think Trump leaning into that is complicated and probably more political. And I really think that balancing rates is a good strategy. The cool thing is, and you know this, Matt, but if the viewers or the listeners want a tool, not a crystal ball, but a good indicator of where the future of rates are going, you know this. There's something called the Federal Reserve dot plot, right? It's the Federal Reserve, the Federal Open Market Committee, the FOMC, literally takes periods of time, whether it's a quarter, year, 2 years, they put dots on a map and show where or on a chart and show where they believe rates will be going. We see that by the end of 26, their expectation is that we drop rates by a full percent. That's interesting.
Yeah, it is.
There's not a lot of notes. They don't give a lot of notes in that actual chart of exactly why. We mostly just hear Jerome Powell, and he kind of goes through some mentality, and sometimes he's a little vague, right? But that's interesting. Do I think rates will drop 1% over the next, year or so? I don't know. Is it a good idea? I don't know. We'd have to see the data at that time. But we know that the Federal Open Market Committee believes that over the next year or so, rates should drop 1%.
Yep. And whether that happens pre or post Jerome Powell leaving his seat in May, maybe that full point's going to come on the, Q2 or Q3, Q4 of next year. We'll see. But, overall, I think to your point, right, I think, and I agree, as much as a real estate investor, I would love to see rates come down. And we all know the ripple effect and benefit that would have. The danger of what inflation could do in what feels like, even though it feels stable and strong, there's still a lot of challenges that everyday Americans and businesses are navigating financially right now, that inflation could be a much bigger domino to squash some really positive momentum than what potentially the, relief of, rates dropping would provide, in my opinion. So I'm aligned with you on that. Brother, this has been insightful, fun. We'll have to have you back on again to chat, kind of the state of the market. And I know for many people that are aligned with what you're saying, right, have gone, one, I, believe in many of these things that you're saying. I want to, diversify based on where, my goals are at, what risk tolerance I have, what I'm really trying to achieve. And this, right? I mean, investing is about suitability. Like, just because something could be a good deal, if it's not suitable to your goals, to your timeline, to your risk portfolio, to like what you're really trying to accomplish, then you shouldn't do it. And I know for a lot of people, income and fixed income as a focus, as a foundational kind of lifeblood for their life and their living is important. So for people that want to know more about Saint Investment, what you guys are doing, what you guys are offering, where can they connect with you guys?
Sure. So that's exactly right. We focus on fixed income backed by real estate. Our fund pays up to 14.28% fixed returns. But the best place to learn about us, we do webinars consistently on big topics, economic deep dives, strategies for investing. They're long webinars. We have live Q&A at the end. They can find all of those resources at saintinvestment.com/resources, and they can find everything about our investment opportunities there as well.
Nic, thanks for coming on the show, brother.
Matt, I had a great time. Catch up with you soon, man.
Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at millionairemindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at the wiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys. Getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media at Official Matty A, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow. You want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Millionaire Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself, in your wealth, on your march to $1 million and beyond. Cheers.